If your goal is to get into real estate to retire, to have financial freedom and security, and to live life on your own terms, retirement should be stress-free, not stressful. I have 5 tips for you guys based off of what I've learned in my 6-7 year real estate career, doing $50+ million of real estate deals, having achieved financial freedom, and having worked and talked with a lot of other people that have done the same things. Tip number 1 is that when you are first in the beginning of your real estate investing career, especially if you don't have a lot of money, you need to be focused on value add deals. Now, in my world, there are 4 kinds of deals. Number 1 is turnkey. This is a property that you can go and you can buy that is already rented out, it's already an investment property, and chances are it's going to be really easy as an investor because everything is already in place and everything is set up. The downside is you're probably not going to make a whole lot of money. I mean, over the long term, I think this is a better place to park your money than in stocks or bonds or really anything else because it's a productive asset. It's an asset you can park your money in, but it's productive, meaning it produces cash flows. The second kind is a stabilized deal. It's very similar to a turnkey deal, but the only difference really is that there's not property management in place. It may or may not be occupied by a tenant, but this project doesn't need a lot of work. Generally speaking, it'd be easy to get a tenant in there and be very easy to move it to a turnkey investment, okay? Third kind of deal is a value add deal. Value add deal really, I think, is the sweet spot for so many investors. You can go and you can buy this real estate at a discount because it needs some sort of work. It needs either a renovation on it. It may need marketing help. It may need a new website. It may need new property management involved. It may need all of those things, or it may just need one or the other. But we can buy it at a discount compared to what it would be worth, this same property, if it had already reached and maximized its potential. And the big thing that we look for here is how can we increase the income? How can we increase the rents on this property? Because that's what's going to drive the value of this property up. A lot of people think value add, think, oh, I'm going to go flip a house and it's got 50-year-old carpets in it, and we're gonna go put in, brand new hardwoods or whatever, and we're gonna add value that way. Yes, that's true. You can add value to residential homes, but I'm talking primarily about investment properties. The fourth place that you can really make a ton of money, but it comes with so much additional risk, is real estate development. It's probably the most profitable, but it's also the most risky. And so when you're starting out, you don't want to get into that because there's long time frames where you have to put money and energy and effort into deals, and it may not work out. You may lose money. You may not see money for 2+ years in some circumstances. And so I think the fourth way, which is development, is not for a beginner. So value add is great because it's the lowest risk way to make the most money. And here's some real numbers. I bought a storage facility in the early part of my career. It was about 20,000 square feet. I bought it for $500,000. I got an owner financing deal where I only put $30,000 down on that deal. Okay, the deal needed another $40,000. So it was a total of a $70,000 investment. I didn't have it. I went out and raised the money for it. And then 2 years later, I sold that property for $1.2 million. And so we turned $70,000 into $700,000. It was huge for me, right? I mean, it's huge for anybody getting started in real estate investing to be able to turn $70,000 into $700,000. And that's the power of value add deals, because when I bought that deal, there was really no cash flow in it, but it also wasn't cash flow negative, meaning it wasn't going to be losing money every single month. And all that was really there, as long as I paid attention to that investment, was an upside, a great upside in that deal. So that's the first piece. When you're getting started out, focus on value add deals where you can turn $70,000 into $700,000, right? Focus on those deals where there's a big upside with not a lot of downside. That's the number one step. The second tip here is focus on cash flow, right? Retirement is all about buying properties that are going to produce cash flow to support your lifestyle and do whatever you want to do. So whenever we go out and we're looking at, hey, I've gone from 70 to 700,000. Now I want to figure out, how do I maximize my cash on cash? That's the metric we're looking for. Simply stated, that's how much cash flow a year. Cash flow is a real estate word for profit. How much profit a year is this going to make me, divided by how much is it going to cost me to go out and get. If that $700,000 I made, which some of it was my investors, some of it was mine, but let's just look at that as one pie. If I went out and I bought a property that produced $35,000 a year of cash flow, then that would only be a 5% cash on cash, which isn't very good. On the other hand, I could have made the decision to go and buy another value add property that I could have done the same thing on, but let's say there's a bigger upside in cash flow in this one. Well, maybe I could go and turn that $700,000 into something, a property that made $350,000 a year of cash flow, right? And the beautiful thing about being a real estate investor is that you get to make these decisions of what you want to do. And so focus on cash flow heavy properties as you say, hey, I'm 3 years away from when I want to retire. You need to start focusing on acquiring cash flow heavy properties and not necessarily properties that are going to have this huge upswing in value. In order to build a lot of wealth, we want to focus on properties that have really high valuations for how much income they have. So that'd be like apartments, industrial centers these days, retail, self-storage, all these have really low cap rates versus like mobile home parks, RV parks, they have higher cap rates. If you say, hey, I want to retire in 5 or 10 years, focus on the high valuation properties at first and then focus on the higher cash flow properties later. And that's how you're going to maximize and shorten that time frame to retirement. The third thing that I want you guys to focus on as you're going through this is multiple units. And what I mean by that is not just multiple properties, but within each and every single property, I want you to focus on, am I buying properties with multiple units? Because whenever you have multiple units, multiple tenants paying one set of income, you're diversifying your risk, right? If you own one property with one tenant in it, then that one tenant doesn't pay, all of your income goes away, you have to come out of retirement. Versus if you go and you buy a 32 unit apartment complex, you have 32 people paying your rent. You have 32 people contributing to your income. And so if one person doesn't pay or two people don't pay, you're still fine. You can still stay happily in retirement. Versus if you put all of your money into a single property with a single tenant, you have this huge amount of risk that doesn't make a lot of sense for somebody who wants to be in retirement. So focus on multiple units. Retirement should be stress-free, not stressful. Fourth step is whenever you're buying these properties, I want you to get long-term, and this is in the beginning and in the end of your career, get long-term fixed interest rate debt. I don't care if it costs you more money. Like here's an example. Whenever you go and you get a loan, they're gonna give you some options. They're gonna say, hey, I'll give you a 3-year loan at 4%. I'll give you a 5-year loan at 4.25%, or I'll give you a 7-year loan at 4.5%. Okay, all day long, I'm taking the 7-year 4.5% because I don't want to have to worry about that debt needing to be paid off, the interest rate going up whenever I have to renew, because these are the kinds of levers in your real estate business that can really impact the bottom line and the cash flow. I think you should always have debt. I don't think you should ever not have debt, even into retirement. My goal is to never be debt free. I will always have debt on my properties, and you should too, because that's how you maximize your value. The key though is, if you're talking to somebody or if you're even thinking yourself like, hey, I'm gonna get a 6-month loan. Ew, that's scary. A year-long, 2-year-long loan, even 3-year loans really scare me. I don't like to acquire any debt that is shorter than 5 years, and I prefer 7 years. And I like to get fully amortizing loans that are never due. They're out there. They're going to cost you a little bit more, but that's fine. The extra cost is worth the peace of mind and the stability of having that interest rate locked in. So that's my fourth tip: long-term fixed interest rate debt. Every single time you possibly can get it, pay more for it. It just makes all the sense in the world and peace of mind as you go into retirement. Your biggest singular cost item will be debt, and if you can fix that expense, it'll really help you through. Number 5, at the end of the day, if you want to retire, you have to know your numbers. You have to know your numbers going into deals, and you also have to know your numbers as you own deals. This is the main reason that I started my software company, My Property Stats, because as stock investors, you can log in, you can see your portfolio instantly 7 times a day, and it's different every time you log in. Real estate investors, as I've found, from people who own hundreds of millions of dollars of real estate to people who own one single rental property, do not know their numbers. If you want to comfortably retire, you need to, not even need to, you have to know your numbers and know that the cash flow that your portfolio produces today and the cash flow that your portfolio is going to produce into the future is going to be enough to sustain your lifestyle. If real estate is going to be your primary source of income, you need to know not only what it's gonna happen today inside your portfolio, but what's gonna happen in 1 year, 2 years, 5 years, 10 years. And so if you currently own any real estate, or if you're thinking about getting into real estate investing, My Property Stats can help you out through either our world's best deal analyzer as you go out there and you try to acquire properties, or the investment management suite, which you can actually take all of your properties, you can put them in there. It'll tell you how you're doing, which properties are underperforming, which properties are doing great, which ones maybe you should sell. And it'll also forecast into the future for you what your portfolio will look like in the future. So you can say, hey, at what time period over the next 1, 5, 10 years, what time period am I going to be able to comfortably retire based off of the numbers inside of my portfolio? So that's my 5th tip, know your numbers. If you don't want to use My Property Stats, no worries. You better get inside to be able to be really good in Excel and build yourself some spreadsheets, have yourselves an accountant, whatever you need to do, know your numbers, have confidence in your numbers. It is ultimately important. At the end of the day, knowing your numbers and being confident in it is what separates rookie investors from people who invest with confidence and have financial freedom. And those are my 5 tips, guys. So I hope you liked this video. If you did, do me a favor, smash that like button, subscribe to the channel, and I'll see you in the next video.